So starting out, just to go over an agenda, so national economy and demographics, talking about some of the drivers, particularly how it pertains to multifamily and multifamily demand, what we're seeing now and what we're looking forward to over the next few years. Then diving into multifamily itself, so supply, demand, vacancy, rent growth, looking at specific markets, but generally looking at a broad look of the multifamily market nationwide. And then Boris is going to take through a live CoStar walkthrough as well. And then, of course, questions and discussions. Love to get as much interaction as possible and field questions and see what you all think of what we're presenting on. So without further ado, national economy and demographics and what we're seeing nationally and how that's going to affect multifamily going forward. So it's really no secret that it's been a strong run for employment gains. This expansion, you see unemployment continues to fall and is basically near record lows, the headline unemployment rate, that is. And the U.S. continues to add jobs at a relatively strong pace, around 200,000 a month. And that's been strong and consistent over the past few years, despite an unemployment rate that's plunged below 4%, something a little bit rare. And we look at that headline unemployment rate, the question is kind of begged, well, where are all these new employees coming from? Where are all these new workers coming from? Because once unemployment gets below 5%, especially 4%, that usually signifies a tight labor market. Well, what you see here, especially paying attention to the gray line, employment of prime age workers, so 25 to 54-year-olds, even though unemployment has shrunk to essentially record lows, that headline number, the population share, the prime age workers still isn't at even pre-recession levels. And it's not even close to where we were at the height of the dot-com boom. So where do these people keep coming from? How do we keep bringing people back into the labor force? Well, there are people that are still sitting on the sidelines, who are still out of the labor force. And one of the things that brings them back in are high quality jobs, better wages, better wage growth. We're starting to see a tick up in that prime age employment as a share of population. But as you could see, there's still some room to grow there compared to historical norms. So what that means for multifamily demand is there's still people out there who aren't employed, who aren't working, and that's potential demand for housing. And a person who isn't employed, who isn't a head of household, typically if they do make that jump, they do find a job, they're not going to go right into home ownership, they're going to go into the renter pool. So this is potential pent up demand for apartment, for rental demand going forward this late in the economic cycle, despite such low headline unemployment. Another trend that we can, I'm sorry?
Oh, yeah, quick question. Do you want to save questions to the end, or do you want to take questions throughout?
I think we could save them to the end. I mean, if you think that whatever you think is best.
Yep, let's do that. Cool, go ahead.
Okay. So another trend that we monitor in particular as it relates to multifamily demand is young adults. So the prime age workers, but also your young adults, because these 18 to 34-year-olds are the most likely to rent within as an age cohort. So one trend that we saw during the Great Recession and has held true even recently is the percent of these young adults who are living at home. See that rise during the Great Recession, and it stayed relatively flat as a percent, 32%, while historically it's more around 27%. Well, as more of these young adults get jobs, they get back into the workforce, that's more potential renters as well. So people moving at, even though they're burdened with student debt, even though, you hear all those horror stories about what happens with student debt and having to live at home and high expense costs. Well, you could view it that way, but you could also view that as there's a lot of pent up housing demand. And similar to the previous slide, most of those people who are forming households when they're moving from their parents' house, they're likely to rent. They're not going to immediately shift to home buying. So more pent-up demand, again, despite being this late in the economic cycle. Also, more people are just living at home. So a broader trend here away from home ownership and towards renting is just more people choosing to live by themselves. You can see the long-term trend of single-person households as a percent of total households. It's about 27% now, a little bit more than that. Way back in the 60s, it was below 15%. And most single-person households, they're predisposed to rent. They don't want to buy a McMansion. They don't typically want to be in a suburb. Single people want to be closer to work and closer to the action. So this, again, a long-term trend towards renting and renting for longer, and a positive trend for multifamily demand just overall. As is the median age at first marriage. So not to, at the risk of belaboring this point, but more single people, less people that are getting married earlier in life. The median age at first marriage in the 70s for men, 23, for women, 21. Now that's 30 and 28. So big sea change in terms of the type of housing that those people are looking for. If you're not married, there's lots of a chance. Obviously, you have children who are school age. You don't need to move out to the suburbs just yet until they're out of school age generally. So more renting for a longer period of time, positive for multifamily demand. Now, one thing that we have been monitoring, and we definitely do monitor very closely, is the home ownership rate. So obviously the home ownership rate increases, that means there's less demand, rental demand, and less renters as a share of total households. So we've seen with the improvement in the economy recently, more people jumping to home ownership. You can see that in the past few years, but it's unlikely that we're ever going to get near those housing bubble peaks, 69% where we peaked in 2005, 2006. We're closer to that historical norm of around 64 to 66%, generally where this stays. So we're still in a sweet spot for multifamily demand overall. And even if the economy continues to improve, it's likely not, it's not likely to shoot up, the home ownership rate shoot up to high levels that we saw during the housing bubble. Now, as multifamily investors, owner-operators, you want to know how fast you could push rents. Well, this cycle, it's been generally the story of fast rising rents, but income's not rising very fast. So the concern is people, especially renters, being rent burdened, and the question of how fast can you raise rents when you have people who are continually squeezed. They're not getting raises and their rents are increasing. Well, the good news is recently, and even since I did this presentation last, wage growth has picked up and inflation has remained relatively tepid. So people now, with the improving economy, they have more in their wallets to spend on rent. So that's helped landlords be able to push rents at a little bit of a better pace, even recently compared to a few years ago. So again, looking at the trend, tighter employment, continue to add jobs, more renters to the renter pool, and those renters are getting a bigger share of the pie and can afford to pay a little bit more on housing compared to just a few years ago. Now I'm going to shift a little bit towards regional demand trends. So this is net domestic migration from 2010 to 2017. The blue is positive net migration, and the orange is negative net migration. And really, the Sun Belt shines here. Phoenix, Vegas, Dallas, Houston, Austin, Atlanta, the southeastern metros that continue to add jobs at an accelerated pace, are relatively affordable, are adding residents from domestically at a really robust pace. So these are the types of markets that, as an investor, you're getting a lot of demand essentially for free. Strong job growth, strong in-migration, and a really robust renter pool for demand. Coastal metros, though, it's not all that bad, considering that they are benefiting from stronger international migration trends. Now, political trends with politics right now in Washington might be concerning with this trend, obviously, but you go back here and people worry about the coastal metros on the west and the east coast. Well, there's still demand, and a lot of that's driven by international migration. So far hasn't been a huge steep cliff drop off, but we're definitely monitoring that as well. Now, looking at the forecast and what we're projecting out for population growth and what we've seen for population growth, again, on the left hand, it's the Sunbelt metros, your Orlando, Phoenix, Austin, Raleigh, expecting to see population growth remain relatively strong over the next 4 years. That's going to contribute to a strong demand pool for rentals. So nationally, to recap the economic outlook, job growth is expected to remain strong in the near term. Wage growth finally picking up, creating more potential runway for rent gains. Mid to long term, demographic trends are mixed. Again, with the immigration trends that we're seeing, we're definitely monitoring that, as well as the baby boomers retiring. Another thing that we're definitely looking at closely. Sunbelt metros, though, should continue to garner a large share of job growth and demand. That's just been a trend over the past few decades and has accelerated this cycle as coastal metros become more and more expensive. Sunbelt metros are adding jobs at an exceptional pace, especially in recent years. So shifting gears to national multifamily outlook. Now, first, I want to set the stage and talk about overall housing. So one thing on a lot of people's minds, really everyone's minds when investing in multifamily, is are we overbuilding? Are we building too much in terms of multifamily? Are we building too much housing in general? What you see here is from the census 1 unit, so that's your single family housing deliveries on trailing 12-month basis, and then you have your 2 to 4 units, not too many of those, your duplex, quadplex, and then 5+, which is your multifamily. Well, we're not really building a lot of housing, especially compared to last cycle. We're still building less than historical norms, even this late in the cycle. So what that means is even though we overbuilt during the last cycle, the steep decline during the Great Recession and then the slow ramp up and essentially flat over the past few years has left the U.S. with a housing shortage, and we're still feeling the effects of that. Seeing strong performance in multifamily, even this late in the cycle, which is very rare. Now, I also like to caveat that most renters are renters by necessity. They're not renters by choice living in downtown towers. So 78% of renter households earn $75,000 or less, and that's a household, not an individual wage. You see the big bulk, it's 0 to 50,000. And 50,000 to 75,000, that's your Class B, Class C apartment demand in southern suburban locales, where that's where we're seeing a lot of demand for that workforce housing, and those properties have performed exceptionally well over the past few years. Now, looking at fundamentals, this chart is supply, demand, vacancy historical average, and then rent growth at the bottom. So you have the demand in the blue. That's annual units of net absorption, supply, annual supply deliveries nationwide, vacancy in the green, and then the historical average vacancy, the long-term historical average vacancy for the U.S. in the dotted line, rent growth in the green at the bottom. So what we see here, especially in the past few years, is supply starts to kick in 2016, 2017, outpacing absorption. But 2018, I like to call it almost like a reset of the market. Supply was still strong, but net absorption was exceptional. The economy accelerated in 2018. GDP growth, job growth was better than in the previous years. And that led to really exceptional apartment demand nationwide. So vacancies actually fell this late in the cycle last year. Rent growth accelerated slightly as well. The rent growth down there, anything over 2% is considered pretty solid. So being above 2-3% over the past few years is strong performance. What we're looking at in 2019, about halfway through already, another strong year, not quite as strong as last year, but 2.4% nationwide rent growth, again, beyond the historical average, and vacancy still below the historical norm as well. Looking into 2020, a lot of economic shops projecting a bit of a job growth slowdown, a little bit of economic uncertainty due to the looming election. Election years typically lead to a little bit of economic uncertainty and a slowdown in business investment that we've seen recently, but still 1.8% nationwide is right around historical norm. So multifamily is still looking pretty solid as an asset class over the next few quarters. Now, of course, every market isn't created equal. Here we're looking at supply under construction, supply by metro. Many of the metros that you see in the big blue in the net migration slide, you'll see that here. So metros like Dallas, Fort Worth, Houston, Seattle, Atlanta, building a lot of supply to try to house all their new migrants. What I like to look for here, better than the new supply in units, is that percent of inventory. So if looking for a market that might be overbuilding or overbuilt, you look at a market like Miami, so even though it has about 15,000 units under construction, that's more than 10% of inventory. That's a market I might worry about a little bit more than, say, Atlanta or Phoenix, where population growth, job growth in those two markets are really strong, and they're pretty much building at the national average norm. So you would expect to see markets like that outperform in the near term. Again, talking about construction, it's good to caveat that much of the new deals are targeting renters by choice rather than those renters by necessity that I showed a few slides ago. Focus all the way on the right, where under construction, requiring income of 75,000 plus, it's almost every single property, and more than half require 100,000 plus of a household income. So these are either prime suburban deals or urban high-rises, and they're not quite competitive with the B and C class that most renters flock to, and a lot of the job growth has been in, especially in the logistics sector, a lot of the warehouse jobs that are being created in many Sunbelt metros especially. Now looking at rent growth, the leaders recently in million population and above metro areas, Sunbelt, Phoenix, Vegas, those are two late recovery metros. So part of that is strong economic growth recently, not a ton of supply, but some of it is also that they got hit so hard during the recession that they're finally recovering, and this is their time to shine right now. Raleigh, Atlanta, Sacramento, Inland Empire, strong job growth, strong demographic trends, and relatively muted supply, leading to above average rent growth. Now the rent growth laggards, you've got slower growth Rust Belt metros like a Milwaukee, for example, Kansas City, Cleveland, Northern New Jersey, Pittsburgh. That's generally the type of markets that you see here. Metros like Miami, that's a little bit overbuilt. Houston's similar with its own issues of the hangover from Hurricane Harvey and the oil bust and persistently low oil prices. But what I like to note here is even the laggards, everyone's positive and most are right around or above 2%. So even the worst metros for rent growth right now, year over year, are still doing relatively okay. And that's, again, very rare for this late in the cycle. You usually see some markets either go negative or a bunch that are a little bit weaker. But right now, metros really throughout the country have performed well in aggregate. Now, just like all the metros are not created equal, each asset class is not created equal. So separating this into 1 and 2 star are C class in the green, the red, which is 3-star or B class, and the orange, which is 4 and 5 star growth in our A class. So focus on that 4 and 5 star. The supply starts to kick in 2016, 2017. suppresses rents in the A class, not too much of a surprise. The good news is that rent growth has actually picked up in recent quarters, and the A class rent growth has kind of surprised the upside. B and C continue to outperform. C has slowed a little bit more, but the B class rent growth remains exceptionally strong. And you can see it's not really been affected too much by the influx of new supply. So of course it's not 100% not affected by it, but generally, you know, you have a brand new delivery at $3 a foot in an urban area, it's not going to deflate rents in the suburbs in a stick built in a garden style, asking $1 or $10 a foot, for example. Now shifting gears a little bit to sales, the multifamily out of all the commercial property types has done exceptionally well in terms of values and sale prices. So what you see here is our CoStar repeat sales index back to 2008 Q4, the U.S. composite of industrial, retail, and office in the gray, and then the multifamily composite that we see here. And you know, that price growth, that gap, more than 50% since 2008 compared to the other property types. And that's, yes, it's including retail, but it's also including industrial, which has performed exceptionally well. So that kind of balances out. In general, multifamily has been a great asset class for appreciation and sales over this cycle. Now, looking at sales volume and pricing, capital markets investors continue to flood money into multifamily. You can see sales volume in billions on the left-hand axis with the bar, price per unit in the diamond over on the right-hand axis, and since 2015, volume's been exceptionally elevated. 2019, this is year to date. Wouldn't be surprised to have that based off what we've seen so far inch up towards the 2015, 2016 levels. Pricing continues to increase as capital continues to flow into multifamily, U.S. multifamily from really all over, both coastal metros, especially moving south into tier 2 markets, but also some international institutional money as well. And that's held true for Class B sales volume as well. So pricing again increasing, and investor appetite for the B class, which traditionally hasn't been a heavily invested asset class, especially in the Sunbelt metros. It's almost been forgotten when it was a lot of stock overbuilt during the 70s and 80s. Well, now owners are coming in, renovating, making these buildings, making these complexes a lot nicer, making them more desirable, and being able to push rents at a better pace, increasing their value and really their desirability as an asset class for investors. So the national multifamily outlook to wrap up, supply additions, they remain robust, but demand continues to keep pace. So far, so good in 2019 as well. Single family supply continues to lag, which is a strong tailwind behind multifamily. Rent growth, it could continue to outperform if job growth numbers are sustained, especially over the next few quarters. And then lastly, workforce housing products should still outperform, but high-end assets have shown better lease up in recent quarters compared to 2016, 2017. So my last slide is a little bit about CoStar, and Ryder and Boris mentioned this, but CoStar, we own LoopNet, which is the premier marketing platform for anything commercial, including multifamily, as well as apartments.com. So all this data, it's being driven in by apartments.com, LoopNet, and of course CoStar, where we have almost 2,000 researchers verifying and gathering data. My team, we have 90 market analysts and economists, so I'm dedicated to the Atlanta market as well as overseeing the South, but we have extremely robust coverage, over 4,000 reports that are custom written on a daily basis with custom daily forecasts and really up to the minute information. So it's a very powerful tool, and Boris will give you a little deep dive into it.
Awesome. This is Boris. Ryder, how do I take control of the screen?
Sorry, I was on mute. You should see a green share button. David, you've got to stop your share first, and then he'll have
Okay.
the option. Yeah.
Where do I?
There you go.
There we go.
Okay, can you guys hear me? Or sorry, see my screen, I mean?
We see your, yeah, we see your browser.
Okay, great. So what I want to do is just kind of go through a little demo, a little scenario from the investor perspective. So I'm going to go through and sort of play the scenario of I'm an investor. I'm looking to identify multifamily markets to invest. I'm going to analyze those specific markets, and then I'm going to drill into those markets to actually find investments, to find individual properties, and then analyze those properties. So basically, kind of just going over, showing you guys how you could use this if you had access to, you know, accomplish everything I just discussed. So this is the CoStar homepage. When we're starting with market analysis, what we're going to do is we're going to go to the analytics section, go to markets and submarkets. I'll click in here. So you're going to see a bunch of dots show up here on the screen. All these dots represent major metros, and these dots are coinciding with the reports. So right now we're on multifamily, but if I wanted retail reports or industrial or office or any one of the other major asset classes, I can go ahead and switch that. So we have all 390 major markets here, all the multifamily reports over here on the right, and we can drill into any one of these. Let's say that I wanted to filter out markets that don't meet my investment criteria. So if I click on this filter button, what I could do is I could actually filter in markets that have, you know, that are performing with certain fundamentals. So let's say I want to look at multifamily markets with a maximum vacancy rate of 6%. Let's go down here. And I'm going to say I want it to be a larger market. So I'm going to say, where's my population here? Minimum population, 500,000. Then I want there to be healthy job growth as well. So I'm going to say at least 1.5% job growth as of right now. Okay, so what this did is kick back 30 markets that meet that criteria. Now, what we could do is we could view these markets in a list view. So this is going to list out all the markets. We could stack rank the markets by whatever fundamental is important to us. So if I want to find out, okay, out of these 30 markets, which one has the highest rents, I could go ahead and click that header and it'll reorganize those markets. What we could also do is we could compare multiple markets at the same time, looking at any one of these fundamentals as well. So if I click on the compare button, let's take, let's do San Francisco, New York, San Francisco, LA as an example here. I'll hide the rest. And right now we're looking at average rent per unit historically across these 4 markets. I can see how they've been performing quarter by quarter, year over year. This is where we're currently at, where my mouse is, and then we do a 5-year forward-looking forecast on that fundamental as well. And we could analyze any fundamental we want. So right now, like I said, I'm on market rents per unit, but if I want to switch to cap rate or construction information, I could go ahead and do that as well. All right. Going back to the map view, I'm going to go ahead and actually zoom in on a market here. Take a look at San Jose. So we added some pretty cool layering features that allow you to do some additional analysis. So for instance, if I want to look at San Jose and I want to understand, let's say, population density for this area, I could overlay that and get a heat map showing population density. Or maybe I want to look at household income information. Opportunity zones, I don't know if anyone is doing it for opportunity zone investments, but we did incorporate opportunity zone layering into the product as well, so you can identify where the opportunity zones are and which properties are within those zones as well. Last thing I'll show you here in this layering section is we also incorporated some interactive heat maps. So for instance, if I want to look at this area and understand, you know, historically, how has the sales volume been trending, what we can do is play this little interactive map, and this is basically showing us a interactive heat map of sales volume with multifamily properties. So you can see kind of where the hot areas are to invest and at what time. So I'm going to actually drill into one of these reports to show you what this looks like. So we're clicking on the San Jose market. I think most of us are from the Bay Area, which is why I chose this. So drilling into the multifamily market report, this is going to be the reports that are put together by our analysts and economists. They're basically taking all of our data points that we collect and combining it with, David, I believe it's Oxford Analytics is what we're using right now.
Correct, Oxford Economics.
Got it. Yeah, so they're taking all of our data points, combining it with Oxford Economics, and then basically putting out these reports. So right now we're looking at the multifamily market report for San Jose. As far as kind of how to digest this, up top here we have our market fundamentals. So I could go through this here and see, okay, we've got 144,000 units in the market. That's increased via new development by 1.7%. We could see how many units are currently under construction in the market. Net absorption, vacancy, see vacancy staying fairly steady, rose just slightly by about 0.17%. See what's going on with average rent per unit and how that's been changing year over year. So 2.3% rent increase year over year, sale price and cap rate. Now, if I want to do a deep dive on any one of these fundamentals, what I could do is just drill into that specific section. So right now I'm on the vacancy section. This is going to be a quick write-up on what's going on with vacancy rates. And what I can do as well is scroll down and map this out more on a chart view and see what's going on with absorption, vacancy, and deliveries. And once again, all of the charts within these reports are going to look historically back as far as, I think it's about like 20 years back. We'll tell you what the current fundamentals are, and then we do a 5-year forward-looking forecast as well. And you can drill into any one of the sections. So if you want to find out what's going on with development activity in the market or sales volume, maybe you want to read up on what's going on with the economy, who are the major players job-wise, are we seeing growth, are we seeing a recession in the market, you can do that as well. Clicking on the submarkets tab, this will allow me to actually break down the submarkets within the market. So once I've identified that I want to invest in this market, maybe I want to understand how the various submarkets are performing. And what we can do is we can drill into any one of these submarkets and get the same style of reporting just on a submarket basis. So I'm going to click out of this section. So once again, the market and submarket area, this is where you would go to basically identify markets that you want to invest in, drill into those markets and see how they're performing with the various asset types. Now, once you've actually identified a market, you want to start looking for investments, that's where we'd be going to the property section. So property section is where we could search for any commercial or multifamily property. So as far as what we're looking at here, we're seeing a bunch of pins here, gray icons and blue icons. Gray icons are property records. Blue icons they're just properties. Blue icons are properties as well, but the properties that are either for sale or they have space available for lease within them. So if there's any investors here that are looking for properties that are on market and that are going to LoopNet to do so, what I want to do really quickly is just show you a comparison of what you're seeing on LoopNet versus CoStar as far as on-market property count. So what I'm going to do here is, as just a quick example, is I'm going to look at Santa Clara County. I want to look for any property that's for sale. You'll notice that as I do filtering, it's going to tell me up here how many properties were meet the filtering criteria that I've set out. So as far as Santa Clara County for sale, commercial and multifamily properties, there's 505 properties that are on the market. If you're going to LoopNet and doing this same search, you're not seeing all these 505 properties because LoopNet is only taking back properties that are being paid to be advertised. So it's a pay-to-play advertising platform. What I have within CoStar, though, is this button that I could check, and this is just going to show me properties that are not visible in LoopNet. So out of those 505 properties, 205 of them are not visible in LoopNet. So if you're using that as a tool to see what's on market, you're missing about, depending on which market you're looking at, it's going to be about 40 to 60% of the inventory. So I'm going to clear this out. And for this example, let's say that I want to invest in multifamily properties, and I'm going to say I want to look in this custom shape area, this polygoned area that I've selected here. And I want to, let's go multifamily. I want to invest in anything that's, let's do 40 to 60 units. All right, 40 to 60 units. We could see we have 231 properties that meet that criteria. As far as seeing what's on market, let's check for sale for a second here. and we'll see that there's only 2 properties that are actually on the market for sale. Now we can drill into these properties, but what I want to do is show you how individuals use this or how investors use this to source off-market opportunity as well. So I'm going to look at all the inventory that meets this criteria. What we can do is we could view the properties in this picture view right here, but we could also switch to more of a spreadsheet view if I click on lists. So this is listing out all the properties, and I can stack rank these properties or restack all these properties by clicking on any one of these headers. So if I want to stack the properties, let's say by which ones have the most units, I can click the units header and it'll restack that list for me. Let's go ahead and drill into a property, and I want to just show you what type of detail we'll have on a property detail page. So what we're looking at here is going to be 3555 South Bascom Avenue. This is a 16-unit multifamily property, 46,000 square feet, built in 1978, 1.7% vacancy, average rent per unit, all that's indicated up here. So when we drill into a property detail, we're going to have about 13 tabs of information that we can derive on this property. Most of this information will be summarized on the first tab, which is the summary tab. So I can see the last time the property transacted was in '98 for $6.6 million at a 6.8 cap. Building information is going to be below that. So once again, 60 units, average size per unit, year built, class, individually metered, parking information. So we've got 23 surface spaces, 59 covered spaces, etc. Information on the land, amenities, all there. I'm going to drill through a couple of these tabs to kind of go over how you can use some of this information to analyze a specific property. So for instance, clicking on the comps tab, what this will allow me to do is analyze how our subject property is performing on a rental basis compared to its peers. So what we're doing here is we're pulling in 17 rent comps to get this average. And how we're pulling this in is our subject property, the Casa de Rosa Apartments, it's plugged in with us on apartments.com. So we own apartments.com, Apartment Finder, For Rent, a bunch of other apartment listing services. And on the back end, all those listing services feed data into the back end of CoStar. So what we're doing here to pull in these 17 rent comps is we're tracking how renters behave when they click on the Casa de Rosa Apartments on our subject property through apartments.com. And based on which properties they're most likely to click on next, we're generating this renter-driven comp set. So we're kicking back these 17 rent comps, and I'm going to scroll down here so we can see the individual comps. So all the averages are up at the top. Now, let's say I want to stack rank my subject property against the comps and see how we're performing on, let's say, a rent per square foot basis. I can go ahead and do that and see, okay, based on the comparables, we're on a rent per square foot basis kind of towards the middle. Maybe I want to see how we are on a rent per unit basis, or a 1-bedroom basis, 2-bedroom basis. Basically, what I'm illustrating here is you can analyze and see how your subject property is performing compared to the market, compared to its peers. You know, if I was to acquire this property, could I potentially raise the rents a little bit and pull some additional NOI out of it? Scroll back to the top here. Clicking on like the analytics tab, this will actually just port in the market and sub-market reports that we saw in the first section that I clicked into. So if I want to get market and sub-market information for where this property is located, I click on the analytics tab. That's another way to see the general market reports. If you need to do any kind of demographic analysis around a property, clicking on the demographics tab will give you demographic breakdown on a 1 mile, 3 mile, or 5 mile radius from the specific property. Most importantly, contact information. So if you are going to be using this database to hunt for off-market opportunity, you're going to be reaching out to the owners directly. Contacts tab will give you that information. So as far as ownership, we track 2 types of owner records through the contacts tab. So there's going to be recorded owner. This is what you find on title. So on title, we see Casa de Rosa Properties Inc. Doesn't really tell us much, and it's linked to some PO box. What we do is we pierce the corporate veil and we find out who the actual owners are behind this LLC. So that's the true owner section. So Flick Inc. I'm going to click on this, and this is going to bring up a company profile. All right, so this property is owned by Flick Inc. Calvin Locke is our principal here. Here's his phone number if I want to contact him. This looks like a home address, knowing Hillsborough. And then we can see what other properties he owns. So he owns 2 other properties. If I click on the properties tab, this will actually list out the other properties that he owns. So here's our subject property, and here's a McDonald's in Houston that he owns as well. So you kind of do a deep dive into the owner's profile, see what else he owns. Scrolling down to the bottom, if you ever drill into a property that is missing information, through the contacts tab, there's going to be a CoStar researcher associated with every single property in CoStar, where you could reach out to the researcher if anything is missing and ask them to look it up for you. So for instance, if we didn't have a phone number for the owner here and you wanted us to look it up, you would click on the researcher's name and say, hi, SB, please find owner info, send it off to her. Typically within 24 to 48 hours, she'll look that up for you and get back to you with that information. So before I click out of this, what I want to do is just generate a quick report, let that load in the background, and I'm going to move on to a different section here to wrap it up. The full underwriting report, let that generate. So we've found a property that we potentially want to invest in. Let's say I want to understand for what I could buy this property at or what it should sell for. What I'm going to do for that is I'm going to hop out of the property section. I'm going to jump into the sale comp section. And this is where we would go to do evaluation. So we go into the sale comp section and say, return any type of sale information and run averages on that. So what I'm going to do here is, let's do this. I'm going to look at, do a radius around San Jose. I want to look at any multifamily sales that have occurred since, let's go back to the beginning of 2018. So our property, our subject property that we were looking at here is 60 units. So I'm going to say I want to look at any property that's transacted between 25 to 80 units. And I'm going to drop $1 into the minimum sale price, and this will just kick out any $0 transactions for me. All right. So we have our list of properties or properties that have transacted in this time period that meet this unit range criteria. We could view the properties in this nice picture view, but then we could also view it in a list view as well. So I want to drill into one of these sale comps to kind of show you the type of information we'll have on any given property that transacts. Let's take a look at 180 Buckingham Avenue. So what I'm doing here is I'm drilling into an individual sale comp, and this will allow you to see, what happened with this transaction, who sold the property, who bought it, what were the conditions of the sale, what condition was the property at the time of sale, et cetera, where you could basically see whether or not this is a true comparable for the property that we're trying to comp out. So we could see seller information, try on properties, sold this property, St. Francis Center of Redwood City bought it. Transaction detail is going to be right here. So it's going to tell us how long the property was on market, how much it sold for, average price per door, was there any financing at the time of sale, et cetera. And then down here, sale notes, this is just the motivation behind the transaction. So let's go back to our result list. Essentially, when you're doing evaluation, what you would do ideally is you drill through all of these sale comps and you would select the ones that make the most sense to you, the ones that help you tell the story that you're trying to tell. And then from there, what you could do is you could click on analytics. And what that's going to do is it's going to take these 22 sale records and average them out and give me some averages amongst these sales. So we could see that amongst these 22 sales, our average sale price per door is going to be $461,000. Average cap rate is going to be about 4.2%. Average total sale price right here. And then what we can do is we can generate a report on this by clicking the report section. What I want to do is cycle back to the underwriting report that I generated on our subject property and review this real quick, and then I'll just wrap it up. So our underwriting report, you can generate underwriting reports on pretty much any multifamily, industrial, retail, or office property within CoStar. And essentially what this is going to be is a close to 100-page plus report, which is going to give us information on the subject property, on sale comps, rent comps, peer properties, construction information, and then market and sub-market reports. So I'm not going to go through the entire report because, like I said, this one is 133 pages. But essentially, let me zoom in here so you guys can see this better. What we're going to have throughout this report is information on our subject property. Then we're going to jump into a rental comparable report. So this is basically a report version of that comps tab that we saw through the property detail page, where we're listing out all the rental comparable properties, giving you kind of a one-page description on each one of the comparables, so you can kind of see what's going on with the comparable properties in that market. Going back up to the top, construction section, this is going to be talking about what sort of development activity with other multifamily properties is going on around our subject property, so you can understand what kind of competition as far as supply or new construction is hitting the market.
Hey, Boris.
Sure.
Boris, this is Chris. I don't think we are seeing the report that you're talking to. We can see your mouse move, but I think it might be in a different window. Can you make sure that window is shared, the window that shows the actual report?
Oh, yeah. Let me switch over here. Can you guys see that now?
Oh, yeah. Yeah. Thank you.
Okay. Sorry about that. Yeah, so this is the underwriting report. This is basically, it's a 100+ page report that you can generate on any multifamily, office, retail, or industrial property within CoStar. So what I was going through is basically, instead of clicking into each individual section, I was just kind of showing the table of contents of the type of information that's in the report. So obviously we'll have our subject property information. After that, it's going to go into a rental comparable report on this particular property. So this is, once again, sort of the same view that we saw through the comps tab, but in report format. So this is listing out all the comparable properties. And then it's giving you a one-page report on each one of those comparables. So you can see kind of what the unit mix is within those properties, what they're renting at, et cetera. After that, it's going to be a construction summary. So once again, like this is talking about the development that's going on in the area with other multifamily properties and listing out those developments so you can understand what type of supply is being delivered to the market around your property that you're looking to invest in. Then it's going to get into a sale comp report. So this is going to bring in nearby sales. This is an automatically generated sale comp report, but what you could do is actually customize which properties you're including in the sale comp report. Like what I showed you in the sale comp section. After the sale comp report, you're going to have a demographic analysis, pretty straightforward there, and then a multifamily market and submarket report is going to be attached to the end of this report. So it's basically it's a 100-page report. You can generate it in one click on any multifamily property. So if you're working with investors or a bank, you can take this report, bring this to them, and say this is why you should lend on this property, or this is why we should invest in this property, et cetera. Cool. So that's kind of a high-level overview of sort of how CoStar might be used from a investment standpoint. Any questions for myself or for David?
Well, first, thanks so much. That was really impressive. Both parts of the presentation, really awesome.
Thank you.
Great. Yeah. Anyone that has any questions, go ahead and type them in the Q&A on the bottom of your screen, or use the chat section. Either one will work, and then we'll read them out to either Boris or David. I'll give you guys a moment to do that. Meanwhile, my first question is for David. So David, of course, what everybody wants to know is there going to be a correction, and is it going to be within the next year or so? What are your thoughts on this? I think a lot of us have heard Doug Duncan, the economist from Fannie Mae, speak on this not too long ago. It seems like everybody is in agreement that there is not a correction imminent, let's say the next 12 to 18 months. Is that something you have an opinion on, or do you wisely stay away from that?
I'll definitely echo that. I mean, and I listen to a lot of economists. I pretty often go to the Atlanta Fed to hear some of their people speak at a speaker series, and I mean, it looks pretty decent in the near term. I mean, obviously, near term, you could speak with a little bit more certainty. People, and I think I said this last time, it seems like people this late in the cycle are always looking for that black swan event. What's going to plunge us into a downturn? Is it corporate debt? Is it car loan debt? I mean, we've heard some crazy stuff, and it turns out to be, nothing has materialized yet. The fundamentals of the economy are still pretty strong. Mm-hmm. One thing I will say, and I mentioned it briefly, before is in 2016, we did see a slowdown in business investment in 2016 due to uncertainty with the election. I think we possibly could see that in 2020 as well with, businesses, you're not going to hire or move or make a big business decision that particular year because you just don't know how Washington's going to shape up. But again, 2016, it was a bit of a slowdown compared to 15, but then it wasn't a crash or anything like that. So near term still looks pretty solid. And then in terms of multifamily demand, we still look relatively strong, and supply has actually started to slow a little bit. So there's still plenty of cushion there.
Okay, thanks, David. Then you're right. That does definitely seem to echo most other experts that I've that have heard speak on this. So my next question is for Boris. So Boris, where do people get these wonderful toys?
What's that?
Where do people get these wonderful toys? I mean, that CoStar demonstration is absolutely amazing, and if you're in this business, that is pretty much invaluable because you can see what all the others can see, and maybe what they don't want you to see. So where do people like, if they're interested in getting CoStar or parts of CoStar, how do they get that started?
Yeah, absolutely. So I'll post or send out my contact information to you guys, and you can blast it to your group. So basically, just reach out to me directly. What we'll do is we'll sit down and kind of what my job is to understand, what you're trying to accomplish, and then show you how that information is pulled out of CoStar. As far as price and cost, it depends on which part of the database you need access to. So once we can kind of discuss and understand what your strategy is, based on what you need access to out of our data, I can present price on the spot.
Cool. Yeah. Thanks. If you send us your contact information and a quick reminder, then we'll definitely shoot that out to all the attendees, and then anybody that wants to see everything that we just saw can get that going. Ryder, I know you're going to have some questions as well.
Yeah, my question may be kind of a follow-up on Chris's, but and I know it sounds like you have a good pulse on the Fed, but the Fed just kind of announced that they're going to be flat on increases, and it sounds like the market is very certain we're going to have a rate drop the next time they meet. Do you have any outlook on, would you agree with that estimation? And if that's the case, do you think that's a signal that the economy is softening?
So I'll preface that with, and part of the reason why I do attend these Fed meetings is my boss, Galena, worked at the Atlanta Fed for 14 years as a research director. So she helps read the tea leaves for us here, and it's funny watching her watch Chairman Powell give his speech. It's pretty entertaining because she disagrees or agrees with how things are worded. It's just that it's that complex. But one interesting thing one of my colleagues said today was, markets are baking in more of greater cuts than staying flat going forward. So essentially, markets expecting a really dovish Fed, which has the dual effect of does that signal confidence in the economy? So they have to be pretty wary of that as well. That you cut rates too fast, well, maybe that shows that the underlying data is weaker than expected, and that's one thing that they're definitely weighing right now. So yeah, it's been a bit of a dovish turn. The nice thing is inflation is still really low. It's below the target. So if they are to cut rates, we wouldn't see that big run up spike that people would worry about. So in general, it's looking pretty steady now with a likely cut. The markets are baking in for July, but in general, it's nothing that markets don't expect. And then, of course, markets reacting very positively over the past few days, including today.